Now you'll notice that this video is in a different format than most of the other videos from my channel. Don't worry, there is a good reason for this. But for now, let me tell you about a time from a few years ago. I had just graduated from college along with a bunch of my friends. I graduated a little bit earlier than them, but I came back to campus to spend some time with all of them. My friends' names were Tim, John, Sam, and Bella. All of them were all smart in their own ways. Tim tended to do things pretty quickly, liked to just speed through life. John was a bit of the opposite. John liked to take his time. He liked to smell the roses, if you will. You could call it Tim was more type A, John a little bit more type B, but the world just ran on John's schedule. And we had Sam, probably the smartest out of the bunch. She always thought through every single decision that she made and considered all the data around her. And then finally we had Bella. Bella was so nice, but at the same time, maybe the biggest warrior I have ever met. Now, graduation comes and goes. Tim, John, Sam, and Bella all take a trip together to Southeast Asia post-graduation. They tour around for a few months, and they come back right in time for the holidays. Keep in mind, I'm class of 2019, and so they got back, call it around December of 2019. Now, each of them actually got a pretty unique Christmas present, all of them. All of them got, give or take $1,000, let's just call it $1,200, for them to use in however which way they wanted as they got into the workforce. We caught up after Christmas time, and it was clear that all of them wanted to put that money towards some sort of investment. This is the story of how each of their investments panned out. Our story will start with Tim. Enjoyed his Christmas break, and then right as the new year turned around, he went ahead and invested all $1,200 into the S&P 500. He just wanted to put that money into the stock market as quick as he could, and then he was on to the next thing. John was a little bit different. John got the money and kind of just sat on it. He didn't really know what to do. January went by, February went by, and March was starting to go by when John got a little distracted.
China has identified a mysterious new virus.
Coronavirus.
Well, it took him a few months to get used to whatever a new normal was. And one day he's checking his bank accounts and he had heard on the news that the stock market had dropped a bunch. Scrambling, remembering that he had the money to invest, John dropped in all $1,200 in one go in the first week of June into the market. Sam always had a bit of a plan when it came to the money. You see, her strategy was a little bit more thought out than either Tim or John's. Every single month, she was investing $100 into the market. And so at the end of the year, all 1,200 of her dollars had been invested. But based on how the market works, if I invest $100 and the stock price is lower, I'm able to buy more stock. If I invest $100 and the stock price is higher, my dollar doesn't go as far and I buy fewer stocks. With her strategy, she ended up buying at a rate that was somewhere in between Tim and John's. But Bella, man, oh man, Bella was the worrier of the group. The first few months she had heard the stock market was elevated, and she did not want to spend any of her money on any investments. March comes by, and the pandemic, that spooks Bella even more. Things aren't really getting better for Bella as she hears more and more concerns about the pandemic. But suddenly, the stock market bounces back up again, despite the pandemic raging on, which doesn't make any sense to Bella. The risk of losing money to her was far too high, to the point she didn't invest in 2020 at all. Well, 2021 rolled around, and Bella just sees the market go up and up and up, and she's thinking to herself, man, if it was expensive back then, it has to be crazy now. 2022 then also rolls around, and the stock market begins to dip, and she's thinking, oh no, the crash is happening. How much deeper can it go? All said and done, Bella never invested the money. My friends and I all got back together in 2022. We all started reviewing the stats. Tim ended up putting in $1,200 into the market when the S&P 500 was valued at $3,257.85. John ended up investing when the S&P 500 was $3,055.73. And Sam, well, her investment strategy led to a weighted average cost of $3,155.75 for the S&P 500. When we then looked at the investment growth at the end of 2022, we saw that Tim's investment grew to $1,414, a growth rate of 8.6% per year. John's investment grew to $1,508, which is a growth rate of 12.1% per year. And Sam's investment grew to $1,460 and saw a 10.3% growth rate per year. Bella still only had her $1,200 and obviously saw no growth. Now, when you look at the numbers, you might say, hey, there's a couple of things I can take away here. The first one is Bella's investment strategy probably isn't the optimal one, and I would tend to agree with you. There's a saying in the market, time in the market beats timing the market. If you wait for the best opportunity like Bella, it may be that nothing actually comes to fruition. You might also think that John is the one who won out this time. And I don't know if that's as fair of a lesson to take away. Tim and John actually used the same strategy, what's known as lump sum investing. Lump sum investing is if you have a base of capital, you effectively invest it immediately all in one go. What Sam did, where she takes the same amount of money and buys stock with it every single month, is known as dollar cost averaging. This is the other style of investment. Historically, lump sum investing has produced greater returns. Based on research from Morgan Stanley, over the last 7 years, lump sum investors have fared better when picking on dates 56% of the time versus dollar cost average. However, lump sum investing tends to be much more risky. The main reason for this is if you buy at a peak day, then all of your gains can amount to effectively nothing. This risk is pretty heavily mitigated when you dollar cost average because you are putting in the same amount of money on a periodic basis. And when stocks are low, you are going to be able to buy more of the stock. When stocks are high, you are going to be able to buy less. As a result, naturally, you will average and weight towards a lower cost basis, making your investment more likely to be profitable and de-risking it over its tenure. So the question of lump sum versus dollar cost averaging is more a question of risk more than anything else. Now, the other thing you probably have noticed, there's a good chance that Tim, John, Sam, and Bella are not real. And you would be right. This scenario was contrived. However, the personalities involved in the scenario and the investment strategies have been taken from personal experiences of myself and from the friends around me. Hopefully, this video was a little bit more informative in terms of how you can think about investing in the market. And I hope that you take away that time in the market is better than timing the market. And if you have the appetite for it, lump sum tends to be better than dollar cost averaging, but remember, it comes at a pretty heavy risk. With that being said, y'all, thank you for tuning in, and I will catch you next time.